But let's shift focus from equities and actually concentrate on the entire commodity space, especially the metal space, considering that we've had copper prices which have declined significantly, iron ore prices which have been trading at 18-month lows, and not to mention gold, which is now at a 6-month high. Mark Keenan, head of Commodities Research, Asia, Societe Generale, joins in to talk about that. Mark, hi. Thanks very much for joining in. Could you just start by telling us whether you expect a bounce back in metal prices, since most of the investors are talking about the fact that maybe the Chinese trade deficit data for Feb was an aberration, and I say that simply because that was one of the key triggers for the prices to even fall as much as they did.
Yes. The main concern in the market at the moment, to be honest, in the industrial metal sector is much of this increased volatility has been driven certainly by copper's price action of late. And rather than the decline in copper prices having been exclusively attributed to the Chinese data, much of that concern has really been focused around the potential release of copper from these collateralized loan agreements that are in place, where copper is actually used as the collateral in a lot of these loans in the shadow banking sector. And the fear is that as we saw with the default on the Chinese solar company recently, a few days ago, this has sparked some concerns that maybe there's going to be an increased clampdown in this effect, which will cause copper prices in particular, to move lower. That said, the fall in copper prices has been extremely swift, and it's been very large. It's trading now just below $6,500 a ton, which is our forecast for Q4 of this year. So it is relative to our forecast a little bit ahead of itself. Our forecast for the whole year is an average of $6,800 a ton.
Mark, could you explain further the impact of copper being used as a financing collateral in China? Because, there is a fear of it plunging further. So what would the ramifications actually be?
Potentially, yes. It's a significant risk, and it's been something that has been underpinning a lot of base metal dynamics across the complex. Aluminium also being a market very heavily influenced by this dynamic for many years now. The low interest rate environment globally and the curve structure, the forward prices of many of these metals, have made it very interesting to use them as collateral by selling forward physical holdings in the metal and using the interest rate differential and the price differential to generate a yield. Specifically with China and copper, the difficult thing, and the reason why it's a little bit scary, is that there's no precise data on exactly how much copper within the Chinese bonded warehouse system is used in these collateralized loan deals. And the fear is that some estimates are up to 60% of inventory. Okay. The fear is that if the Chinese government do start to clamp down on this and these deals start to unwind, then in a market that's already forecast to be in a short-term surplus at the moment, combined with the fact that we see increased mine supply over the short term, this extra copper into the system in an environment where Chinese growth is definitely slowing down, can cause prices to move lower. In addition to that, and a little bit different from the other industrial metals, copper is trading.
Sure. So Mark, that's on copper, but since we're running out of time, I just wanted to ask you about your targets on iron ore and aluminium prices as well. And what are the triggers that you might have for a movement on the upside or the downside for both of these commodities that you might be forecasting?
Aluminium, very similar to copper. It's heavily influenced, perhaps even more so, by the trade financing deals in place. Aluminium has a much more stable and a much steeper forward curve. It's in contango, so forward long-term prices are at a significant premium to the near-term prices. And that is probably more susceptible to the global interest rate environment. As interest rates rise globally, which we're forecasting to happen certainly in the US in 2015, this may make the appeal for trade financing deals linked to aluminium less interesting, and that could cause much of the aluminium that's locked up to unwind in a similar fashion. Iron ore is less used in trade financing and really more sensitive to the macroeconomic data that comes out of China, as we've seen recently. We've seen a very steep fall in iron ore prices. I think in percentage terms, the fall yesterday or the day before was the largest in 4 years, and we're hovering just above $100 a ton there. The outlook for iron ore is a little bit bearish, mostly on the fact that we see rising production out of Australia into a market that's already heavily oversupplied. So the iron ore is a little bit more focused towards the Chinese data and the specific supply and demand dynamics. The aluminium and the copper also linked to supply and demand dynamics, but has this extra dimension of complexity surrounding these markets as a function of this trade financing positions in place.
Okay. Finally, then, one last question. What about gold? I mean, gold has hit, as we speak, a 6-month high because of perhaps the concerns in Ukraine, the Chinese concerns spurring a safe haven demand. But do you expect gold to bounce back formidably in 2014?
No, not per se. As we discussed last time a little bit, we see this safe haven appeal possibly elevating prices up towards the 1400 level. We're sort of we've broken through 1350 today and look to be slowly rising, and the ETF flows are supporting that. Overall, we're bearish gold, and we see that we see rises in price, these short-term pockets of strength driven by these safe haven appeal or short covering rallies that we saw earlier in this year as selling opportunities. And we see the price of gold at the end of the year down to 1,050.
Oh, okay. 1,050. That's quite a bearish call that you have on gold there. Thanks so much, Mark, for joining us and giving us a view. So that's the word coming in on the commodity space and how to approach it. Still half a